Hello Andrew, and thanks for joining Blue Notes again to talk through the interim result. It was quite a well received result in the end, despite some trepidation initially. Mike Smith described it as well balanced, and I think the investors seem to agree, and part of that was the Asian balance, the Asian diversification, the business diversification. Why is it that the market's now starting to warm to that Asian story, do you think?
Well, I think that they're seeing a positive differentiator versus our domestic peer group. So when you see some of the domestic peers have challenged in the home market of Australia, and then you see strong growth in Asia, it provides that positive differentiation relative to the peer group itself. And I think the investors warm to the notion of seeing the benefit of the super regional strategy delivering and providing that differentiation.
At the investor tour last year in Hong Kong, you committed to a through-the-cycle 13% return on equity for that business, which I think also went over quite well. But is that achievable, 13% through the cycle?
Well, a couple of comments I'd make there. The first is I think it was well received because the organization made that commitment, right? We went out and we said this is our aspiration of what we're trying to achieve. And I don't think they'd heard in the past ANZ coming forth and saying this is the kind of returns we're going to get out of Asia. They want to see returns coming out of Asia, but most importantly, they want to see the organization having a target and setting a target. The second thing, I think the reason why it was well received is that if you look at the competitors who play in a super regional way in Asia Pacific, a 13% return on equity is quite a good return on equity. So, you know, relative to that peer group, it's something that will differentiate us and show that we have a profitable Asian franchise. Mike's
talked about the mix of the business, and you've been speaking about fixing the mix of the business. What do you mean when you talk about fixing the mix there in that business?
When you're a relationship bank, you provide all different types of services to your customers. So, and some of those services are more capital intensive, and some of those services are less capital intensive. And what you have to look at is how much capital do I use in that relationship, and what's the ratio of the less capital intensive activities that you've got. And so you're trying to fix that ratio, that mix, what I call fix the mix. So examples of that would be things like our foreign exchange business, which has been a growing business for us, but we need to continue to have that big growth. Our payments and cash management activity has a high return on equity portion. Our supply chain finance business has a higher return on equity. Our corporate advisory business. So what you do is you get the team focused upon delivering those product suites to the customers and concentrating their energies to make certain that they're talking to the customers about their needs in those products first and foremost, and then the more capital intensive things like lending people money, that tends to have a higher capital ratio attached to it. So we have to try to fix the mix.
And just finally, the macro environment globally is one of a lot of liquidity. Central banks are printing money. The other business you look after is the institutional business globally. In Australia, and institutional margins are down because there's just, well, really, there's so much money around. You know, it's a buyer's market. Do you see that macro environment in which you operate changing in the next sort of trading period?
No, I certainly don't see that macro environment changing in the next period or even the next year. I think it's going to be out there for a while that there's going to be significant liquidity being attracted to Australia and being attracted to the Asia Pacific region. I think the more interesting question as we try to accelerate our execution of the strategy and delivering better returns is to think about what we do around that. What's our response to that? And as an organization in IIB, what we're really doing is continuing to concentrate on what we concentrated on last period, which is to fix the mix. So when I'm down in my lending business here, I will fill that gap with additional earnings in foreign exchange and in our cash management business and our supply chain finance business, for example. And I'll also drive greater connectivity between Australia and the rest of the region. So an example of that is what we're doing around the corridor strategy. And in corridor strategy, we're focused on the corridor, whether it's trade or FDI flows or wealth flows, measuring the quantum of that and our share of that. And, you know, I think we announced the result of greater than 50% increase between what's happening between Australia and Hong Kong. And what you realize very quickly, and when you see those kind of growth rates, you realize quickly is that we're one of the few Australian banks that can do that. You know, when we want to connect customers between Australia and Singapore, or Australia and China, or Australia and Hong Kong, we can own that space pretty strongly, and I think we've been showing that in our recent results.
Well, look, thanks for spending the time with Blue Notes again, Andrew. Good luck with the fixing the mix.
Thank you very much.